So anyway, I want to get started here because I like to keep these to 30 minutes. And I want to give you some good practical tips on how to increase your cash flow in your business. Okay, so first of all, welcome. This is how to increase your cash flow. So I want to help you understand the cash conversion cycle in a business, whether you own a business, you work for a business, you do accounting for a business, whatever the case may be, and also give you some practical tips on how to increase your cash flow pretty quickly, pretty immediately. These are some things you can put in place now. And these are the things that I see at a lot of our clients and a lot of other people, a lot of other businesses that I work with that they can do and they do put in place, and it helps them pretty quickly. Okay, so first of all, a little bit about us. If you don't know who I am, I know we've got a lot of people on the webinar today. And my name is Matt Hultquist with the Hultquist firm. I founded the Hultquist firm in 2003. We are accountants with personality. So we actually get to know our clients. We actually build relationships with them and are not just the cut and dry accountants. So we are a full service CPA firm in Greenville, South Carolina. We have clients across the country, everywhere from Hawaii to Maine. So pretty much all over the place. We really are dedicated to educating our clients, solving problems, and helping people. Okay, so our passion really is to help business owners succeed through proactive tax and business planning, and accounting, of course, naturally goes along with that. We do tax planning, tax preparation, QuickBooks consulting, outsourced accounting, fractional CFO for services, profit first implementation, and of course, audits, reviews, and compilations. Please visit our website at thehultquistfirm.com. Okay, so let's go ahead and get right into this. All right, so I want to talk about cash flow, and you hear a lot about cash flow and why it's so important. Cash flow, you know, when you hear the term cash flow, it may not make a whole lot of sense, but cash flow really is just the money coming into your business. If you own a business or you have started a business, or even if you work for a smaller business and some bigger businesses as well, you'll see that cash is king. I mean, you have to be able to pay your bills, and you have to be able to pay your people, your suppliers, your vendors, etc. And the only way to do that is if you have money in the door. So it does you no good if a customer owes you that money, and it does you no good if you have it sitting in inventory. Okay, so cash in hand is the key to succeeding in business, because most businesses fail when they start up. The main reasons are poor planning and for poor cash flow. Okay, this kills businesses so often it's not even funny. Okay, all right, so the other thing too is if you do own a business, you know, when you have poor cash flow, that's stressful. You know, those sleepless nights when you're wondering how you're going to pay your employees, I mean, that is a stressful time, okay? And that's something that we want to avoid, all right? So let's talk about the cash conversion cycle. Again, this is, you know, a term you may have heard, you may not have heard, but it simply means, you know, how do you turn your products or services into cash in your pocket? Okay, so you have accounts receivables that customers owe you, you collect that money, you get cash, you pay your bills, which is accounts payable, you buy inventory, you make it into product, you sell that product, you get accounts receivable, it turns into cash. So this is a wheel. Okay, the cash conversion cycle, if you think about it just like a wheel, like in this graphic here, you've got to spin that wheel as fast as possible. This is especially true if you are a new business or you are a quickly growing business. You've got to turn this wheel really, really quickly. Okay. Now, I like to refer to the cash conversion cycle as something a little bit different. So I'll go through this whole graphic here, but you know, every business has what's called a cash gap. All right. This is somewhat similar to the cash conversion cycle. Now, the cash gap is the difference between the time it takes the outlay of cash to come back in the door from customers. All right. Your goal in your business is to manage this cash gap and get it as low as possible. So I'm going to walk through how you can figure out your own cash gap in your business, or for any business for that matter. And then also, again, we're going to talk about the practical ways to reduce the cash gap. But this is an important term to remember. is always knowing what your cash gap is, because it is critical to know this and to manage it and to keep it as low as possible to stay in business and to have a healthy business. Okay, so let me show you this graphic here. If you look over on the left there, it says you buy inventory or provide a service. So let's assume that this is day zero. Okay, so you send a purchase order, you buy some inventory. Maybe somebody, a customer calls and says, hey, I need you to do this service, whatever it is. Okay, there's going to be some businesses on this webinar that have inventory, some that don't, some that have accounts receivable, some that don't. But this really applies to every type of business. Okay, so day zero, you buy this inventory, you provide this service. All right, so 30 days later, you pay your bills and your overhead. So during that time, between the 30 days, you've got payroll. You may have some other bills that you've got to pay. So during that 30 days, you pay your bills. So in this example, if you purchase inventory on day zero, 30 days later, if you have 30-day terms with a vendor, you pay for that inventory. That's money out the door, okay? Okay, so then that inventory sits on your shelf, or you provide that service over the next 50 days, all right? So you pay the bills, then that product sits on your shelf, the inventory sits on your shelf, or you work on that service for 50 days, and then you bill it, all right? So now we're 80 days into it. From the time you ordered until the time you billed it, it's been 80 days. Okay, now let's assume that 60 days later, you get paid. Now, in some businesses, this is 30, some it's 45, some it's 90. But in this example, it's 60 days you get paid. So your cash gap was 110 days. What that means is you paid all your bills back on the 30th day, and then it took you 50 days to sell, 60 days to collect. 110 days that you have to come out of pocket to support your business. This is what's called the cash gap. This is that time between money out and money back in. And the job, and what you should be very familiar with, is how to shorten that and how to manage that cash gap. Okay? All right, so let's talk about what makes up this cash gap. This is true for any business. And again, your business, just like my business, I don't have inventory, so inventory doesn't apply to me, but accounts receivable and accounts payable applies to me. So every single business, I don't care what you do, is going to have some kind of cash gap. And again, the goal is to make it as short as possible. Okay, so accounts receivable, this is the first main component. This is what customers owe you and how long they take to pay you. So this is, excuse me, this is if you are invoicing your customers. So you provide a product or service, you send an invoice to a customer, and that is called accounts receivable, okay? Now, how long it takes them to pay you is going to be key, all right? The second thing, the second component of the cash gap that you have to manage is accounts payable. Now, accounts payable is what you owe your vendors. And a measure of that is how long it takes you to pay your vendors, okay? Some people pay their bills immediately, some stretch it out as long as possible, but the measure is going to be an accounts payable, how long does it take you to pay your vendors? Okay, and the last one is inventory. So a key measure is how long inventory sits on your shelf before you sell it. So you buy it, you put it on the shelf, it sits there, it sells 50 days later, it sits on your shelf for 50 days, okay? So again, important thing here, 3 components of this cash gap: accounts receivable, accounts payable, and inventory, all right? So let's talk about, I don't want to get too much into this because this gets a little bit technical and detailed, and I'm happy to answer any questions about this after the webinar. If you send me an email, I'll show you my email afterwards. Happy to answer any questions for you. But just briefly, I want to talk about how to figure out the cash gap in your own business. These are very, very simple calculations. Okay, so first of all, you have to have good bookkeeping, good accounting, and you have to keep your books on an accrual basis. And what that means is that you're putting invoices in and you're tracking those invoices. That's your accounts receivable, and you're putting in bills and you're paying your bills. That's accounts payable. Okay, that's the first step. Now, assuming you're doing that, you can calculate what's called the days sales outstanding for accounts receivable. All that means, that's a fancy term for how long does it take on average for your customers to pay you, okay? That number could be immediately, it could be 5 days, 20 days, 60, 90 days, doesn't matter. How you're gonna calculate that though, is you simply take, and again, this is looking at your basic financial statements, your profit and loss and your balance sheet. So this days sales outstanding, you simply take accounts receivable, that's what money people owe you, divided by your sales, and you multiply by the number of days. And here, let me give you an example of that. So let's say that you're measuring it for 1 month, okay? For April 2019, you're gonna take your accounts receivable balance at the end of April, you're gonna divide it by your sales for April, and you're gonna multiply it by 30 days. Simple as that. If it's for a year, you're gonna take ending accounts receivable at the end of the year, divided by sales for the year, multiply by 365. And this number is going to tell you on average how many days it takes for your customers to pay you, okay? So I encourage you to figure that out in your own business because sometimes it can be eye-opening. All right, accounts payable, this second measure of the cash gap, same kind of calculation, this is called days payables outstanding, and this is a measure of how quickly you pay your bills, all right? So a lot of business owners, first of all, don't know how long it takes to collect from their customers. And second, they really don't know how long it takes to pay their bills. So again, this is a simple calculation. And it's your accounts payable, which is what you owe your vendors, divided by what's called cost of goods sold. And you multiply that by the number of days, okay? So again, accounts payable, if it's a month, you take the ending accounts payable at that end of that month, divide it by cost of goods sold for that month, multiply it by the number of days. And there are certain adjustments for service businesses, but you can calculate this for a service business as well. All right, the last one is inventory. All right, we want to figure out how many days of inventory do you have on hand. All right, and so what we look at is what's called days sales in inventory. So that's how much sales do you have sitting on your shelf that's sitting in inventory. And this is really a measure of, you know, do you have excess inventory? Do you not have enough inventory? All right. So again, this calculation is your average inventory divided by cost of goods sold, all right, times the number of days. Again, these are very, very straightforward, simple calculations. And again, if you have questions on it or need some help calculating this, let me know. I'm happy to help. All right. So then the cash gap is you simply take the days sales and inventory plus the days in accounts receivable and subtract the days in accounts payable, okay? That is your cash gap. So if we went back to the previous slide over there, that would be that 105 days, I think is what I calculated on there, 105, 110 days, that's your cash gap. So I encourage you, go figure this out in your own business because this will give you a baseline for where you're at. And then a good rule of thumb is to measure this on a monthly basis so you can track it over time because we want to get it down with the tips I'm going to show you and you can measure how well these tips are working for you, okay? All right, so quick example here, simple example of the days. It takes 45 days for customers to pay us. We pay our bills in 30 days and our inventory sits on the shelf for 90 days. Cash gap's 105 days. This means that in general, it takes you 105 days to convert your products or services to cash, and you, as a business owner, have to finance this cash gap somehow, whether you borrow it from a bank, it comes out of your pocket, or a credit card or something like that. But you are on the hook for that. You have to finance that. So the goal is to get this down, and now we're going to talk about how to do that. All right. Okay, so the first one, and I'm going to spend a little bit of time on this one, accounts receivable, because there's a number of things that you can do to reduce the time it takes your customers to pay you. And with any of these tips, you're going to have to test some of them out because some of them work in some industries, some of them work with some customers, and some don't. You can do a little bit of research, maybe on an industry website if you're a member of an industry association, see what other businesses are doing. Maybe you know some people that own a similar business to yours, ask them what they do. But every industry, every type of business is going to respond differently. And so you're going to have to play around and see what works for you. But there are a couple things here that are applicable to everyone. Okay, so accounts receivable. The first thing, this is so basic, but it rarely happens. You need to send your invoices as soon as possible, okay? You know, all too often I see where, let's say, a service is provided, it's completed and delivered, and the invoice isn't sent for 2 weeks. Or maybe you invoice once a month at the end of the month, okay? But if you provided a service or even a product on the first of the month and you don't bill until the 31st of the month, that's 30 days that you are expanding the cash gap in your business, okay? So first and foremost, invoice as soon as possible, okay? And within a lot of businesses, I mean, you can set this up to be done automatically with software, you know, or if you have somebody sending your invoices, but you need to demand and make sure this is a process in your business that as soon as a product or service is completed, an invoice is sent immediately, okay? Now, the second one, make sure invoices are clear, detailed, and concise. Now, I know as a business owner, you want to make sure you have your logo on your invoices. You want to make it look all nice. You know, it's a reflection of your business. But what ends up happening is in the process of making it look all pretty and nice and, you know, all that great stuff, you forget some things, okay? So you need to make it as clear and detailed as possible on that invoice. And there's a couple things you need to make sure you have on there. One is you need a very good description of what was done or what was sold to that customer. If it's vague, they are going to set it aside when they get it because they're going to have to call you for an explanation. They may set it aside for 3, 4, 5 days, maybe 2 weeks. And then they may wait till you follow up with them. And when you do follow up, they're going to say, you know, this was really vague. I need to know what you did. And so then you're going to have to reissue the invoice, get it sent to them, and then they're going to act as if they just got it at that date, okay? So be as detailed as possible on the invoice so there is no question what product or service was delivered, okay? Number 2, put the terms on the invoice. Put the due date, a specific due date, and the terms. Make this very, very clear, okay? I see a lot of invoices that have no due date. It's just an invoice. There's no terms. It doesn't say due in 30 days, just an invoice. So to me, I can pay it whenever I want, all right? So be very clear. You expect them to pay by a certain date on certain terms. Okay, third, tell them where to send the payment, all right? If they're sending a check, put a footnote on it that says, please make checks payable to, put the name, and put the address. Because again, you know, I see a lot of invoices with just your company name and address at the top, maybe a phone number, and then no payment instructions. Okay, do I make it out to this address? Do I mail it here? You know, so again, make it clear. You want to leave no question in your customer mind, questions in their mind as to, you know, when it's due, how much is owed, what was done, and where to send the payment. Okay, so again, make it as detailed as possible. All right. Number 3, follow a consistent collections program. This is by far the number one thing I see that people don't do in their business, all right? They send an invoice, and then they wait. And then they may look at it a month later and say, oh my gosh, you know what? So-and-so hasn't paid yet. You know, I better send them a statement, or I better call them, or whatever the case may be. Then you get busy, you fall behind, and too many businesses have invoices out there that are 60, 90 days past due that were due on the 30th day. So you need a consistent program. What I mean by that is you have to do it consistently. Pretty self-explanatory, okay? So first of all, send an email before the due date. I like to send them about 5 to 10 days before the due date to say, hey, this is a friendly reminder that you have an invoice coming up that's due. Call them on or after the due date. All right. A lot of times emails are very easy to ignore, but when you call somebody that you have a relationship with, a customer, they're more apt to pay you pretty quickly. And always remember that the squeaky wheel gets the grease. So the more you call and the more you send a follow-up, you're going to become a priority because they want to get you off the bat. Okay. All right, so we have a client we work with, and we are literally sending an email 10 days before the due date, 5 days before the due date. We call when it's due, and then we call every 3 days after that until we get paid. All right, so we don't want to irritate our customers, but at the same time, we know that we need to get this money in the door quickly. So be consistent, and don't do it once and think it didn't work. All right. Now, the other thing I want to mention is, and I did a video on this, and I will send the link into this video I'm talking about with Biller Genie. I did an interview with the CEO of the company showing how to use Biller Genie, but essentially Biller Genie is a program that once you create the invoice in QuickBooks, it automates everything after that. All right, so it sends the reminders, it sends the past due, it calculates finance charges. So I encourage you to watch that video. I'll send you a link after the webinar, and watch that video, because that is something that can save you a ton of time and automate the process. All right, next, I want to talk about adjusting payment terms. All right, so right now, if I encourage you, never give customers as a small business more than 30 days to pay. I don't care if it's a huge contract. If they demand 60 or 90 days, it will kill your business. Simply don't do it, okay? Unless you have a lot of capital and you can absorb it. But otherwise, it will kill your business because you'll run out of money, okay? So again, you can adjust this and say, if you normally give 30 days, drop it to 15. Or if you give 15, drop it to 10. If you give 10, maybe drop it to due on receipt. All right, you got to play around with this. The other thing is what's called early pay discounts. You can't encourage customers to pay early if you give them a discount. And a lot of times this can be worth it to get that money in the door quicker. Some common ones you may have heard of are 1% 10 net 30 or 2% 10 net 30. That means if they pay within 10 days, they get a 1 or 2% discount, but it's due within 30 days. Okay, you can make up any terms you want. All right. Okay, the next one is make it easy to pay. All right, a lot of times people make it so difficult for a customer to pay them. Okay, make it easy. Set up online payment. Biller Genie gives you a customer portal, so you can put a link on your website. They can pay you there. They can pay you through email. They have their own customer portal with their own login they can pay. You can set up recurring payments, but make it easy for customers to pay, and give them the ability to pay by online, ACH, or credit card. All right, they're going to pay much more quickly. Okay, the next one is finance charges. All too often businesses threaten this and they never do it, or they do it, they never collect it. What I find effective is more or less the threat of a finance charge, and this is done through an email, maybe 5 days or 3 days before the invoice is due, simply saying, hey, want to remind you your invoice is due on this date, and I don't want to assess you a finance charge, so I wanted to send you this friendly reminder. Otherwise, you will be assessed a finance charge of X%. Okay? Last one is credit checks on new customers. As your business grows, you can't just take on every single customer that comes through the door. And so you want to start a credit check program to where you're checking the credit of these customers beforehand. Check out their payment history. Did they pay on time? Because you can avoid a lot of headaches down the road by checking this stuff in advance. Okay? All right, so let's move on to accounts payable. So I've got a picture of a snail here and a payment. And the goal here with accounts payable is to take as long as we can to pay our vendors, okay? Now, here's how you're gonna do this. And this takes some judgment and it takes some playing around with. But first of all, you've got to track due dates to your vendors for the bills that you owe them. The easiest way is gonna be in QuickBooks, because you can pull up a listing in one screen that shows you these bills are due on these dates, okay? That's first. That's going to be key. Otherwise, you have no idea what's due when, other than simply looking at a bunch of paper, and that gets to be a mess and very time consuming. Okay? Now, the next one, and this sounds simple, but you have to proactively do this. You want to pay your bills as late as you can to avoid penalties. Now, this is going to seem uncomfortable because you want to pay your bills. And you may have the money immediately. Hey, I'm just going to pay all my bills through the end of next month. Don't do it. Okay? Pay your bills as late as you can to avoid penalties, okay? Next, ask for better terms consistently. A lot of vendors will give you terms of 15 days or 30 days. you need to, on a consistent basis, ask for better terms. What I like to do is ask for better terms every 2 months, okay? Because as you start to show a consistent payment history, they're going to be more apt to give you these payment terms. So again, a lot of people will try it once, they'll call their vendors, they'll do it 1 month and say it didn't work. And they wouldn't give me better terms. Call them again. If they don't do it again, call them again, okay? It is time consuming, but you can often get much better terms the more you ask. Again, same as accounts receivable, the squeaky wheel gets the grease, okay? The next one is a lot of times if you're buying inventory, you may be able to get early pay discounts yourself. So just like you're giving them to your customers, your vendors may give them to you. The other thing is you may be able to buy things in bulk and get a discount so you get a better margin, okay? If you're struggling with cash flow, 2 things. Don't take advantage of early pay discounts because you need to hold on to your cash. Doesn't matter if you get that 1 or 2% discount, hold on to your cash and don't take advantage of them. Second thing is typically it doesn't make sense to buy in bulk because if you're buying in bulk, that means you're buying more than you need to fulfill and sell to your customers, which means that's going to sit on the shelf. It could sit on the shelf for 6 months. Well, that's cash now that's sitting on your shelf. You can't use it to pay your bills. So a lot of times, avoid the bulk discounts, avoid the early pay discounts if you're struggling with cash flow. And the last thing is implement Profit First. That is a program. I did a webinar on it a couple months ago. I will also send a link out in the follow-up email with the recording of this webinar. Watch that webinar because you can take full advantage of what's called Parkinson's Law, and you will naturally slow down your payments to your vendors and find ways to save money, okay? Very, very important. Okay, let's talk a little bit about inventory. All right, so inventory management, again, you need a consistent ordering program. What I mean by that is instead of being reactive with your inventory, be proactive, okay? When you are reactive and you need something immediately, you're gonna end up spending more money, most likely, okay? So by a consistent program, I have it down as the last thing here, using an inventory forecasting tool. If you are not using a software that tracks your inventory, tracks what was sold, and over how long a period of time, you need to get one. And the reason is because it will tell you when you need to order and how much you need to order. So you can simply send blanket purchase orders to your vendors, your suppliers, and say, I'm going to be ordering this much over this amount of time, and then have them do releases as you need them, okay? This is a great way to manage your cash flow. Like I said before, avoid those bulk purchases if you can. That is if your cash is tight. Now, if you have tons of cash, first, you probably wouldn't be watching this webinar, but second, buy the bulk purchases. You can afford to sit on some of that inventory. All right, next, liquidate or move unnecessary or sitting inventory. Get creative with this, all right? If you have stuff sitting around, get creative. We had a client we were talking to, and he had a bunch of excess stuff sitting around, and it was a retail website. And we said, well, why don't you, okay, if you have, say these hats that aren't selling, why don't you have some kind of sale where if they buy one full price item, they get the hat at 30% off or half price, all right? It's a way to at least free up cash for that inventory. Otherwise, it's just sitting there, all right? So find ways to give sales, discounts, get creative, and move that inventory that's not moving, all right? And then finally, get better buying terms from your vendors. Just like in the accounts payable, be consistent, ask for better terms. All right. Okay, so we're going to be winding this up. We're right here at about 9:30. All right, so just in summary today, you don't need to be an expert or an accountant. You really just need to understand the basics of this cash gap and the cash conversion cycle. And it's really, really simple. All it is accounts receivable, how long it takes for customers to pay you, accounts payable, how long you take to pay your vendors, and inventory, how long does stuff sit on the shelf. Those 3 things are vital to your cash flow, and you need to start measuring them and track those things month to month, and then implement these practical tips to get paid quicker, pay vendors slower, and not let inventory sit on the shelf. And then finally, test to see what works. I mean, you're gonna have to play around with this and see what works. All right, and lastly, one of the most important things, and I always say this, your books have to be in good order. They have to be accurate for any of this to even work or make sense. Without good books, you can't calculate where you're at. If you don't know where you're at, you don't know how to reduce it. Okay? Got to get good books. All right, so any questions, contact me with any questions. I'll leave this up for a minute or two here, but there is my email address. You also had gotten the reminders on the webinar. If you signed up for the webinar, that has my email address. There's my phone number, website, LinkedIn profile, Facebook page for the firm. Check us out, visit us. Happy to answer any questions. I appreciate your time today. I hope you learned something, and I will talk to you soon.